We all know Nike as one of the best performing stocks over really the last 30 or 40 years. But I think there's another sporting goods company that is better positioned with better growth and better margins than even Nike. So I want to compare Nike to On Holding. If you're not familiar with On Holding, they make the On brand of shoes, started as a running shoe company. Now they moved into apparel and tennis shoes. I think there's a number of other markets that they can move into, but just a very fast growing company. And so it's fascinating from an investment perspective to look at what investors are paying for Nike and what they can get on for today. So that's what I'm going to be comparing. My name's Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. Check out fool.com/ASYM for their top 10 stocks to buy right now. And let's start with the first chart, and that shows the price to sales ratio of these two companies, because I want to lay the groundwork for exactly what we're paying for both of these stocks. You can see that On is obviously much more expensive than Nike, trading for about 5 times sales. Nike is trading at closer to 3 times sales, so a pretty hefty premium that you're paying for On Holding. But there's a good reason that you're paying that premium. So let's go to the company's growth rate. This is the growth rate for both On and Nike, and you can see the trends are pretty similar. And you can see that the ups and downs are pretty similar, happening at similar times. Obviously, spending has pulled back a little bit in the third quarter, but the growth rate at On is just far exceeding the growth rate at Nike, 46.5% over the past year. 46.5% is On's growth rate in the most recent quarter, just 2% at Nike. And this is something that is expected to continue. On has said that they're going to double revenue by 2026. And so that's their guidance, their long-term guidance, but they're actually beating their guidance just even short-term. The third quarter numbers were much better than investors expected. So I think we could exceed even that. I wouldn't be surprised if the company doubles revenue by early in 2026. So just a phenomenal growth story for On. And like I said, you're paying a little bit of a premium, but that is worth paying for if you're getting a lot of growth. The other big differentiation On has is profitability. I'll get to that in just a second. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. I want to just start by showing both of these companies and their websites just to give an idea of what their products are, how they're similar, how they're a little bit different. You're probably familiar with Nike, but making everything from shoes to all kinds of athletic gear. They have every price point under the rainbow. This is Nike, but they also have the Jordan brand, which is a little bit higher price point. Track and field, so lots of niche products. And obviously a brand that's been growing for decades at this point. So On is a little bit newer brand, and On is started with running. This is the cloud that a lot of their original shoes are really built on. There's little bubbles on the bottom, a little bit like the Air Max back in the old days. And they're now moving into other categories. I mentioned apparel, so a lot of this is running related apparel, and then accessories. And you kind of get to running adjacent products. So road running, trail running, lifestyle. This is something that I think has been very successful in kind of the US urban environment. So people that are wearing sneakers as more like fashion items. So this would be more in the lifestyle. And then you have hiking and outdoor products. And like I mentioned, tennis is the other specific brand that they're really starting to build products for. And that is because of their deal that they had with Roger Federer that happened pre-IPO. Here's a look at their running shoes and kind of the styles that they have. And you can see that this cloud is really something that they lean into with a lot of their designs. So just to give you an idea of exactly what they're building from a brand perspective, On is still a little bit more niche, kind of reminds me of Lululemon in a little bit, not quite the same niche market, but maybe that gives On a little bit more of an addressable market, given the fact that running and lifestyle is potentially a bigger market than yoga is. This chart shows On's gross profit margin compared to Nike. And gross profit margin is going to be just simply how much money do they make on each shoe or piece of apparel that they're selling. And On has really gone after this premium segment. Shoes sell for in excess of $140. And the company has said that it doesn't discount, something that Nike just simply has to do given the scale of the business. So you're seeing these margins improve over time, and management has said that they're expecting gross margins over the next 3 years to be at about that 60% range. So they're expecting to keep that premium price point even as they're expanding distribution to more and more markets and more retailers. So this will ultimately lead to On being more profitable from a net income perspective. We're not quite there yet. You can see in this chart in blue, what you have is net income, and the company is starting to generate a little bit of a net income, about $80 million in net income over the past year, but that is very low compared to the $1.7 billion in revenue. If we look at Nike, there's a much more consistent net income margin, typically just over 10%. But we have not gotten to that point with On Holding. And the reason for that is companies that are growing, typically companies that are growing in the physical goods space, where you have to build out manufacturing, you have to build out distribution, you're spending a lot on sales and marketing. Profitability really lags the growth. And in a lot of cases, if you're growing in excess of 50, 60%, you're actually going to report negative net income. So it's very impressive that On Holding has actually maintained positive net income despite the fact that it's growing so quickly. But we will see over time that eventually they'll get to profitability and there will be a lot of operating leverage in the business. That means that net income will grow much faster than sales at a certain point in the business. Maybe that will be 5 to 10 years down the road, but that's what you would expect for a company that is growing this quickly. You're going to forego profitability today for more profitability in the future. That's exactly what we're seeing for On Holding. But the playbook is really here with Nike. You can see that the profit margins, if they're around 10% from Nike, given the higher gross margin for On Holdings, we could see their net income margin be 20, maybe even 25%. So that would be extremely impressive if they're able to maintain those kind of margins. The other thing to think about is the growth runway for both of these companies. Nike has basically expanded into all the markets that it possibly could from a sporting goods perspective. They've even begun exiting some markets that weren't particularly successful, like some of their golf products. But On is just now starting to get into that growth trajectory. I mentioned that this is a company that's well known for running shoes. That's really where they started. Their founders are runners and long distance runners specifically. So triathlons were the thing that they were really focused on. They moved into tennis shoes. They had a deal with Roger Federer. So there is a Federer On Holding shoe. And now they've gotten into things like apparel. But I think we'll see them expand into more and more products, particularly in the kind of products that can be considered fashion products as well. I would love to see them moved into more triathlon products, given that is kind of where their heart and soul is, where they really started as a business. There's a lot of apparel that goes along with that, with both long distance running and biking and even swimming. Could potentially make some acquisitions in that area. And they have a lot of opportunity to grow internationally. This is a company that has a lot of penetration in Switzerland, where they're founded, and in certain parts in Europe. But there's a lot of growth opportunity in the US and then in other international markets. So this is a growth story that may just be getting started. And like I said, not only a revenue growth story, but also a bottom line growth story. So when we compare Nike and On Holding, I don't really think there's any comparison on which investors should lean towards. On Holding is the far faster growing company. It's got better margins. Yes, it's not quite as profitable yet, but in time, this will be a company that will likely generate more as far as a net income margin than Nike can. And the premium that investors are paying is less than double the price to sales ratio. That will be eaten up very quickly if the company can double revenue by 2026 as they anticipate. So I think On Holding is a great buy if you're interested in sporting goods stocks. One of those brands that I think we're going to see more and more of in the future. But what do you think about Nike versus On Holding? Do you have a little bit different opinion? Leave those comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.